What if I told you that one man turned a small investment into a fortune worth over $100 billion without trading every day, chasing hype, or buying meme stocks? That man is Warren Buffett, often called the Oracle of Omaha. His strategy isn't based on luck, it's built on patience, discipline, and smart investing. In this video, you'll learn the exact principles that made Buffett one of the greatest investors in history, and how you can apply them too. 1. Buy businesses, not stocks. Most people make a common mistake when they start investing. They look at a stock as just a number on a screen that goes up and down every day. Warren Buffett has a completely different mindset. He believes that when you buy a stock, you should imagine you're buying the entire company. That means you're becoming a part owner of the business, not just someone hoping the share price will rise. Before Buffett invests, he asks several important questions. Does the company have a product or service that people will still need 10, 20, or even 30 years from now? Is the company making consistent profits year after year? Does it have honest and capable management? Can it survive during economic downturns? If the answers are yes, then it's a business worth considering. For example, think about Coca-Cola. Millions of people around the world drink Coca-Cola every day. The company has one of the strongest brands in history, operates in almost every country, and has generated profits for decades. Buffett didn't buy Coca-Cola because he expected the stock price to jump in a few weeks. He invested because he believed the business itself would continue growing for many years. The same idea applies to Apple. Buffett isn't just investing in smartphones. He's investing in a company with a powerful ecosystem, loyal customers, strong profits, and continuous innovation. People who own Apple products often stay with the brand for years, giving the company a major competitive advantage. This teaches us an important lesson. Instead of asking, "Will this stock go up tomorrow?" ask, "Would I be happy owning this business for the next 10 years?" If the answer is yes, you're thinking like Warren Buffett. 2. Invest for the long term. One of Warren Buffett's most famous quotes is, "Our favorite holding period is forever." This simple sentence explains one of the biggest reasons behind his incredible success. Today, many investors want quick profits. They buy a stock in the morning and hope to sell it for a higher price a few days later. Buffett avoids this approach. He believes that real wealth is created by owning great businesses and giving them enough time to grow. In the short term, the stock market can be unpredictable. Prices may rise because of good news or fall because of fear, economic uncertainty, or global events. Many investors panic during these periods and sell their investments at a loss. Buffett does the opposite. If he still believes the company is fundamentally strong, he often sees falling prices as an opportunity to buy more shares at a discount. A great example is the 2008 financial crisis. While many investors were selling because they were afraid, Buffett invested billions of dollars in strong companies. He knew that although the market was struggling, quality businesses would eventually recover. As the economy improved, many of those investments produced substantial returns. Long-term investing also allows you to benefit from compound growth. When a company grows its earnings year after year, its value often increases over time. If you stay invested, your investment has more time to grow, and those gains can continue building on themselves. This is one of the most powerful ways to build wealth. The biggest lesson from Buffett is that patience is an advantage. You don't need to react to every headline or market swing. Focus on buying excellent businesses, ignore short-term market noise, and give your investments the time they need to create long-term value. 3. Stay inside your circle of competence. One of Warren Buffett's most underrated investment principles is staying inside your circle of competence. This simply means investing only in businesses that you truly understand. Buffett believes you don't have to know everything about every industry to become a successful investor. Instead, you should focus on the industries and companies you understand well. For example, if you understand how a company makes money, who its customers are, what its competitors are doing, and why people continue to buy its products, then that company may be within your circle of competence. But if you can't explain the business in simple words, it's probably better to stay away. During the dot-com boom in the late 1990s, thousands of investors rushed into internet companies without understanding how those businesses would make profits. Buffett refused to invest in many of them because they were outside his circle of competence. At the time, many people criticized him for missing the trend. But when the dot-com bubble burst, many of those companies collapsed, while Buffett protected his investors' money. This principle teaches an important lesson. Never invest because of hype, social media, or fear of missing out, FOMO. Just because everyone else is buying a stock doesn't mean it's a good investment. Great investors know that saying no to opportunities they don't understand is just as important as saying yes to the right ones. Before investing, ask yourself, how does this company make money? Can I explain its business model to someone else? Do I understand the risks? If the answer is no, it's better to wait and learn rather than risk your money. 4. Look for competitive advantages. Warren Buffett loves companies that have a strong competitive advantage, which he often calls an economic moat. Just like a castle surrounded by a moat is difficult to attack, a business with an economic moat is difficult for competitors to beat. A company with a competitive advantage can continue earning strong profits for many years because customers trust its products, competitors struggle to copy it, or it has unique strengths that others don't have. One of the best examples is Coca-Cola. People all over the world recognize its brand instantly. Even though there are many soft drink companies, Coca-Cola has built customer loyalty over decades. That's a powerful competitive advantage. Another example is Apple. Apple customers often stay loyal to the brand because all of its products work together. If someone owns an iPhone, they are more likely to buy a MacBook, Apple Watch, or AirPods. This ecosystem keeps customers coming back and makes it harder for competitors to take them away. Buffett also looks for companies with strong management, consistent profits, and the ability to raise prices without losing customers. These qualities help a business remain successful even during difficult economic times. When evaluating a company, ask yourself, what makes this business different? Why do customers keep choosing it? Can competitors easily copy it? The stronger the competitive advantage, the greater the chances that the company will continue growing over the long term. 5. Buy at the right price. Even the world's best company can become a poor investment if you pay too much for it. That's why Warren Buffett doesn't just look for great businesses, he also waits for the right price. Imagine you want to buy a luxury car that's worth $50,000. If someone offers it to you for $35,000 in excellent condition, it's a great deal. But if they ask $80,000, it's no longer a smart purchase, even though it's still the same car. The same principle applies to stocks. Buffett follows the idea of a margin of safety, introduced by his mentor, Benjamin Graham. A margin of safety means buying a company's shares for less than what you believe they are truly worth. This gives you protection if things don't go exactly as expected. Buffett is famous for being patient. He doesn't chase expensive stocks simply because everyone else is buying them. Sometimes he waits months or even years for the right opportunity. When the market becomes fearful and stock prices fall, he looks for quality companies trading at attractive prices. This teaches us that successful investing isn't about buying quickly, it's about buying wisely. Patience can often be one of an investor's greatest strengths. 6. Avoid emotional decisions. One of the biggest enemies of successful investing is emotion. Fear and greed cause many investors to make poor decisions. Warren Buffett has built his career by staying calm while others panic. When stock prices rise rapidly, many people become greedy. They believe prices will continue going up forever, so they buy without thinking about the company's true value. On the other hand, when markets fall, fear takes over. Investors panic and sell their shares, often at the worst possible time. Buffett does the opposite. His famous advice is, "Be fearful when others are greedy, and greedy when others are fearful." This doesn't mean buying every falling stock. It means looking for strong businesses that have temporarily become cheaper because of market fear. For example, during major market crashes like the 2008 financial crisis or the 2020 COVID-19 market decline, many investors sold everything in panic. Buffett stayed focused on business fundamentals instead of emotions. While others reacted to headlines, he looked for opportunities. A successful investor should always make decisions based on research, company performance, and long-term value, not on emotions or social media trends. Remember, the market rewards discipline, not panic. 7. Let compound growth do the work. Perhaps the most powerful reason behind Warren Buffett's enormous wealth is compound growth. Buffett started investing at a young age and allowed his investments to grow for decades. Compounding happens when your investment earns returns, and then those returns begin earning returns of their own. Over time, this creates a snowball effect, where your wealth grows faster and faster. Imagine planting a small tree. During the first few years, it grows slowly. But as it becomes stronger, it produces more branches, more leaves, and eventually, more fruit every year. Investments work in a similar way. The longer they remain invested, the greater the power of compounding. This is why Buffett rarely sells great businesses. Instead of constantly buying and selling, he gives his investments time to grow. Decades of consistent growth have turned relatively small investments into massive fortunes. The key lesson is simple. Start investing as early as possible, stay consistent, and be patient. You don't need to become rich overnight. Even small investments can grow significantly if they are invested wisely and given enough time. Warren Buffett often says that time is one of the greatest assets an investor can have. The earlier you start and the longer you stay invested, the more powerful compound growth becomes. 8. Warren Buffett's biggest investment mistakes. Many people think Warren Buffett has never made mistakes, but that's simply not true. Even one of the greatest investors in history admits that he has made expensive investment decisions. The difference is that Buffett learns from every mistake instead of repeating it. For example, Buffett has openly said that he waited too long to invest in companies like Amazon and Google. He understood that these were incredible businesses, but he underestimated how much they would continue to grow. This teaches us that even the best investors can miss opportunities. Another lesson is that Buffett never lets his ego control his decisions. If he realizes he made a mistake, He accepts it, learns from it, and moves forward. The message is simple. You don't have to be perfect to become a successful investor. You just need to make more good decisions than bad ones and keep learning throughout your investing journey. 9. Why Buffett keeps a large cash reserve. One thing that surprises many investors is that Warren Buffett often keeps billions of dollars in cash instead of investing every single dollar immediately. Why? Because Buffett believes opportunities don't appear every day. If all of your money is already invested, you won't have cash available when great companies suddenly become cheap. Think of cash as ammunition. During market crashes, when fear causes stock prices to fall, Buffett already has money ready to invest. This strategy also reduces unnecessary risk. Instead of chasing overpriced stocks, Buffett patiently waits for the market to offer better opportunities. Patience isn't a weakness, it's a competitive advantage. 10. Buffett's daily habits that built his success. People often ask Warren Buffett about his secret. His answer isn't a magic formula. He spends most of his day reading. Buffett reads annual reports, financial statements, books, newspapers, and business news for several hours every day. He believes that knowledge compounds just like money. He also avoids unnecessary distractions. Instead of constantly checking stock prices every minute, he focuses on understanding businesses. Another habit is surrounding himself with intelligent and trustworthy people. Buffett believes that the people around you have a huge impact on your success. His daily routine proves that successful investing starts with continuous learning. 11. Common investing mistakes beginners should avoid. If you're new to investing, there are several mistakes Warren Buffett would tell you to avoid. First, don't invest in something just because your friends or social media say it's the next big thing. Second, never borrow money to invest in risky assets. Debt can multiply losses just as quickly as profits. Third, don't panic when the market falls. Market corrections are normal. They have happened many times throughout history, and markets have always recovered over the long run. Fourth, don't expect to become rich overnight. Building wealth takes time, discipline, and consistency. And finally, keep learning. The more you understand investing, the better your decisions will become. Now the biggest question is, can an ordinary person follow Warren Buffett's strategy? The answer is absolutely yes. You don't need to be rich or have thousands of dollars to start investing. Buffett believes that successful investing is based on patience, discipline, and smart decisions, not luck. Think about two investors. The first one keeps buying trending stocks because everyone else is buying them. When prices go up, they get excited. When prices fall, they panic and sell. The second investor follows Buffett's principles. They invest in strong businesses, stay patient, ignore short-term market noise, and think about the next 10 or 20 years instead of the next 10 or 20 days. Who do you think is more likely to build long-term wealth? The answer is obvious. Another important lesson from Buffett is that your best investment is yourself. Read books, learn about businesses, improve your financial knowledge, and keep developing new skills. The more you learn, the better your investment decisions become. Remember, wealth isn't created overnight. It's built through small, smart decisions made consistently over many years. That's exactly how Warren Buffett became one of the greatest investors in history. So, if you want to follow Buffett's strategy, remember these key points. Buy great businesses, not just stocks. Invest for the long term. Control your emotions. Stay patient. Let compound growth work its magic. These simple principles have stood the test of time and can help anyone become a better investor. If you found this video helpful, don't forget to like, subscribe, and turn on the notification bell for more videos on investing and personal finance. Thanks for watching, and I'll see you in the next video.